One of the things that we always try to do in these shows is try to be as forward-looking as possible, and sometimes you have to take a step back and look at, how did we do, where were we, and fortunately at this point in time, when you look at the Atlanta Fed GDP Now estimates coming way down, where we did pretty well. Like, this is something that we've been talking about, we've been seeing it, all of the data has been, when you look at the leading indicators, have been showing that there's going to be a marked slowdown. Here we are. Now, the average forecasts continue to be elevated. Well, they'll likely come back down prior to the release of the GDP, but there's just a continuous problem when you look at, okay, but where are we now into Q4? And in the next few components, we want to talk about how Q3 is really bleeding into Q4, and we're not seeing a huge step up. And if anything, we're seeing a continuous slowdown in some of these areas, which again, they're still kind of bumping along the bottom. It's not that they've fallen into a negative category. It's just they're not showing much growth, but very much kind of the weakness that we've seen exiting Q3 and really kicking off Q4. And I think this was an interesting one when you look at the estimates for the Atlanta Fed at 1.33%, just as inflation expectations continue to move higher. And by that, we're using at the U.S. break-even of the 10-year at 2.5%. So you're just seeing this bifurcation, and all of this is culminating with a debt ceiling, a Fed taper. So you're seeing some of that additional fear and some of the additional problems that are coming through that is going to really increase the difference in which these are going to go. And not to say that we're going to go into negative growth, but it's hard to see a lot of continuous growth given a lot of the government transfers have been used, savings have been whittled down. Where is this going to go from here? And that's when we start turning to consumers. And consumers are struggling to procure both everyday items and major purchases. And I thought this was interesting because more than a third of adults seeking housing, groceries, or new cars had trouble procuring. And I don't know, for those that have been to BJ's or for those that have been to the food store, there are bare shelves. And when you ask them when are they coming in, they kind of look at you and be like, when it shows up. And we're continuously seeing that because it's not, let's just talk about, because we've talked about it before, Gatorade Zero. What makes it zero, or that the sugar supplement, has been in short supply. So when you look at that, there's an issue with a piece of the process. It's not the whole process. It's not multiple. I mean, some things have multiple issues. As we said last week, contractors are saying 94% of them said they're short at least one item. It doesn't mean that they're not short 10. It's just at least one item, which is, again, a huge overhang for where these pressures continue to go, and it's coming through across the board, paper goods, obviously with cars. And this is, you start saying, well, I'm just not going to buy it, or then you panic on the other side and you buy too much. So again, you're seeing some of these issues that are going to continue to sit throughout the system. And then price sensitivity. So let's look at price sensitivity reduced purchases for more than half of the adults under the age of 45. So when you look at what prices have done in general, decided not to purchase an item because it was more expensive than a previous. From 18 to 44, over 50% decided not to purchase something, decided against buying something because of the estimated shipping time, canceled an order because it took too long to. So when you look at the increase in price sensitivity, that's when you start seeing the demand destruction. And that's going to be the one to watch, because price sensitivity reduced purchases for more than half of adults under age 45 last month. That is the one that we want to continue to look at, because now, given the sample set is 2,200 U.S. adults, I am not saying the sample set is big, but I know from my experience that this is 100% accurate. There are times that I've gone in and I usually get something and it's a treat for myself or for my kids, and I walk in and I go, nope, and then walk right back out. There is a real problem when you look at some of this pricing, and not to say there's some things that you can't avoid. but you might use less of, or you might just avoid or spend differently. Now, all of this is happening: demand destruction, growth, raising rates. But when you look at B of A, private client equity holdings as a percent of AUM is the highest it has ever been. So at what point do you see a deleveraging? At what point do you start to see of, hey, we've had a decent run, we're coming into taper, we're coming into some of this uncertainty, let's take 3% off the table. And I'm not saying that you have to come back to the peak from '07. Like, this is not coming down 11%, but at some point you get some exposure shift, which I think is going to be interesting, especially when you look at it from the perspective of inflation. And these are, this is Liz Ann Saunders, where if you're not following her on Twitter, you're missing out on some fantastic data. But when you look at this, you can see just where inflation is. And it's all trending up. CPI consumers year over year is at 5.3%, and you can see a little bit of a tail curl over. Rent is still coming back in. That's going to bump it back up. U.S. personal consumption expenditure, that core PCE, still on its way up. Then you look at some of the ones that are lagging. They're starting to creep higher. You're starting to see some of this shift. And especially look at the Fed Reserve median CPI. It's the pace is picking up. You're starting to get this little curl. And again, we expect to see this accelerate over time. And again, that's going to pull up that trimmed mean as well. So various inflation metrics giving mixed messages. CPI slightly off its peak, core PCI flat, but not yet moving down. Cleveland Fed median CPI slowly rising, still low versus historics, and trimmed mean still tame. But again, it's all about what makes it up. And what do we see coming forward? We've showed commodities, we've showed shipping, we've showed PPI in general. All of them have gone up or have stayed flat, which again is going to be a huge driver for where this is going to go in general. And the reason why is because we have reached a new record imbalance on our trade, so the trade deficit widened to $73.3 billion, just eking out the last historic, which was 73.23, and we came in at 73.25. So just give you an idea of how close we are, but we're just bumping along the bottom, and we're importing inflation. We are going to continue to import inflation. When you look at PPI abroad, when you look at shipping rates, when you look at container rates, all of this is going to show up here, and we're going to increase the amount we're forced to buy. So the trade deficit widened to $73.3 billion in August. The estimate was 70.8. August trade deficit widened forecast. So again, there's really nothing to say outside of imports rose 1.4% in August to $286.99 billion from $283.01 billion, and that is, if you've been following us, September is going to be bigger, October is going to be bigger, and then we're into holiday rush, which again is going to keep that elevated. So when we look at ISM Manufacturing, so let's look at where we sit. We came in better than estimates, and you're starting to see some of that restocking on the inventory side. Employment still not quite positive. It's better, but still not quite where it needs to be to see some of this movement. But in general, you're starting to see inventories pick back up, and you're starting to see a little bit of a curl. So companies are buying. So essentially, demand destruction has started at the consumer level, but it's hard to see right now because companies are trying to kind of bridge some of this gap by buying some of that inventory. So when we look at services, here's where you can see employment continues to be a big driver higher, but supplier deliveries are just going through the roof. So if you take out some of these delivery times, you're still in expansion, but you're starting to see some of this underlying slowdown, which again is just kind of this mixed message of what is really driving it, which is why when you look at prices received, prices paid, that supplier delivery is going to keep those prices elevated as we go forward. And looking at that ISM services, the expected was 59.9, came in at 61.9. So still off the highs, but still elevated. As we've been saying, we expect services to continue to outperform with overhang coming in the manufacturing side, and prices paid are moving back higher. And we see that going back to the highs that we had previously in terms of where things were. Now, shifting back to ISM Manufacturing. So the index came in at 61.1. The estimate was for 59.5. But production fell. So production fell from 60 down slightly to 59.4. We think that comes down. Employment rose from 49. So it went from contraction to 50.2 to just over expansion. And we think that that's going to continue to struggle, while supplier deliveries rose exponentially from 69.5 to 73.4, putting more pressure on the manufacturing side. And then when you look at customer inventories, slight increase from 30.2 to 31.7. Prices paid, nice spike from 79.4 to 81.2. Again, seeing that pressure to the upside, but new export orders fell from 56.6 to 53.4, which is more of a future indicator of it's still growing. We still have new export orders going up, but it's not at the pace that we were seeing previously as even as backlog falls, which means that there's a little bit of a catch up, which people are there's also a little bit of, well, let's wait to see if prices soften. Let's wait to see if they get a little bit better. And you're starting to see that kind of creep into the market as well. And when you put it all together and look at PMI versus employment, so employment right back to kind of right where it was, as new orders kind of flatline, as well as the overall PMI. So then when we look at report on business supplier deliveries, you can see that there's that nice little spike back up, and we think that's going to continue to go back to the highs given everything that we've seen through on a leading indicator. When you look at, as we talk about in the EIA show, what's happening at the LA port, what's happening with time to get into a slip. When you look at when we talk about the amount of availability of trucks, what the cost of diesel is. Again, all of these things are creating some of the not only increase in prices, but also the increase in delivery time. So when you look at supply slowdowns intensify and prices paid tick up. So when you look at prior month, there's not too much adjustment made where the supplier delivery delays got a little bit worse. Order backlogs got a little bit better. Prices paid still massively elevated. Employment still well below the 2010 to 2019 range. So all in all, numbers slightly better, but the mix of what makes it better is still kind of still struggling to kind of show some of these bigger shifts. So then when you look at the rotation, and this is one of the things that we've been talking about, the loss of momentum in consumer spending in 3Q was worse than expected according to August spending. The fact that the Delta wave has crested leaves prospects intact for 4Q, but you're starting to see even that not really materialize in the same way. But when you look at the mix, that mix means higher prices in general. So we're going to see prices go up again, which is just creating some of these overhangs as we continue to see some of these shifts. So total spending rose 0.8%, slightly higher than consensus of 0.7%. But when you look at what that metric is, goods continue to come down. So you still have services that have come up, but goods continue to drift lower as the mix goes from goods to services. And that's where, and when you look at that on a pricing level, services inherently cost less, but you're starting to see prices come back up. And again, those prices are going to be a big driver going forward. And when you look at that new order, so new orders are staying flat, but production, it just can't catch up because of these shortfalls, which is causing prices to remain elevated, which means people have to wait longer or they have to use an alternative. And again, all of these things continue to kind of marry to create this delta that is not going to be closed anytime soon. And inventories at U.S. retailers are still way below historical levels, but curling. And that's what we're starting to see. Some companies starting to say, okay, well, even though prices are elevated, I need something to prepare me for for the holiday push. I mean, I don't know about you guys. I've already bought my Christmas decorations. So let me just clarify this. My kids, I let them, or my wife and I, we let them buy one thing to go outside. So we try to accumulate more stuff, not be the tacky house, but trying to steer them in the right direction. But we let them pick out something new so they can be a part of decorating and being a part of the holidays. We did it now. Why? Because I have no idea if it's going to be there. Most of this stuff is coming from China. Was everything available? Sure. But do they have 1,000 of them, or do they have 100? And that's what we're continuing to see. So you're seeing, even at these these inventory to sales ratios, they're still not seeing that pickup, leaving people, I think, naked going into the holiday season. And how has that extra spending shifted? So when you look at households that received unemployment benefits, you saw a huge drop down in that spending, even though, and when households that didn't, things didn't change all that much. But even though it didn't change that much, you're still seeing a drop. And that drop is, again, that's the inflation. That's the cost of things going up. So it's exponential for those that it's expired, and now it's starting to creep in for those that didn't get any benefits, and you're starting to see some of those adjustments. Again, a lot of this is showing a negative kind of movement going into Q4, which again is where we see some of the spending as government transfers end. As that government spending comes down, the consumer will also slow, again, capping where Q4 growth can really go over the next few months.